Hello, everybody, and welcome back to Stateside Market Report with Bryant and Tim. It is Tuesday, February 21st, and we're here to talk today a little bit about financing. Bryant, what do you think about that?
I think it's important, Tim. I
Is that
think
an
uh
important piece of real
I
estate?
think I think yeah, I think financing is pretty important to get a house unless you're made of money and you can just, buy with all cash, which
Yeah, and
there's not a
that's what
lot
all our
of them
clients
out
do.
there.
They
Yeah,
just come in
right.
with
Yeah. It's the State
stacks
Department,
of
right?
bags with dollar signs on them and just drop cash on the closing table. Be done with it.
Yeah. I
Us.
think understanding financing is a whole different ballgame though. It's there's a lot more options than I think people realize there is, right? So I think that's kind of what led us to talking about it today is, there's not really creative financing, I guess. Creative financing is more like seller financing or something like that, right? But
Yeah, wraparound
there's
loans.
alternative financing options other than
Non-conventional.
right, conventional
Non-conventional.
or
So,
FHA. Yeah, non-conventional.
yeah.
That's a good way to put it.
Yeah. So, I mean, we're not going to go into a whole, detailed spiel on financing here, but I think in this environment, people are freaking out about interest rates. Although you and I both know that we're at kind of historic averages. So again, we've talked about this for the past couple of weeks. We're returning to normal. Like 2021, 2022 was not a normal market. 3% interest rates are
Mm,
not normal. Historic average is between 7 and 8%. 6% sometimes. So we're right there, we're right back at a normal historical interest rate
yeah,
environment.
we're slowly
However,
working our way back.
right, and we've just been spoiled. We've been spoiled for, since the Great Recession in 2008. We've been spoiled with incredibly low interest rates, and people that took advantage of that are doing very well. But people that were not in a position to be first-time home buyers or investors at that point are now saying, "Oh, I missed the 2.5, 3% rates. We're now at 6.5. What, I missed it. I'm done. I'm waiting for them to come back down again." And as we talked, I don't know if it was last week or the week before that,
It's
we
just
don't
not
see
going to
rates
happen.
coming back down again
No,
anytime really soon because we're in a severe inventory lack, and we're still trying to fight inflation, and all these macro policies are going into place.
exactly.
So, laying the groundwork like that, I think we should talk about some interesting ways to pursue financing in this environment. And I'm going to start off with ARMs, adjustable rate mortgages. So these are what we call non-conventional loans. There are conventional conforming loans that meet the requirements of Fannie Mae and Freddie Mac that are sold on the secondary market to these government-backed entities. Those are your typical, FHA loans, VA loans, 30-year conventional financing, 15-year conventional financing, fixed rate mortgages, stuff of that nature. But when you get into ARMs or adjustable rate mortgages, first of all, there's a very negative connotation with them stemming from the 2008 recession. A lot of these subprime
Why is that,
mortgages were
Tim?
great question, Brian. I'm glad you asked. Let's go into it. So a lot of these, there were just a lot of sharks. There were a lot of predatory lenders in 2006 through 2009 that were just offering subprime mortgages to people that couldn't afford them. Like they used to say, if you could fog a mirror with your breath, you get a loan. And that was kind of the case. And that we all saw what happened in 2008 because of that. So people would, just put in these adjustable rate mortgages that could adjust up and down at, the flip of a switch, and people just couldn't afford them. That's not necessarily the case anymore. I mean, there are institutional lenders, and these are called portfolio lenders typically. So these are people that will give loans and keep them on their own books. So they kind of set the rules. These aren't conventional loans that they have to sell and meet these strict underwriting guidelines to sell them to Fannie Mae and Freddie Mac. They are kept in-house, so they can kind of write their own rules within certain guidelines. And these are the folks that we work with locally that can provide these kind of more interesting products to help you kind of navigate this inflationary environment. So we'll just go into a couple. I mean, they run the gamut really from, 5 1 arms, 7 1 arms, 10 1 arms. You're going to talk about 2 1 buydowns. Like there's all kinds of vernacular and jargon in the industry, and we'll try to shed some light on the general principles behind it. So we'll talk 7 1 arms. So 7 1 arms mean that you're gonna take a loan from a lender, a portfolio lender that's going to keep it on their own books, and you are going to pay the same interest rate for 7 years. After 7 years, every year it can adjust up or down. So another thing, a negative connotation with ARMs is that, as soon as the 7 year hits, it's going to skyrocket. It's going to go from the 6.5% you locked in to 18%. Like that's not the case. If the federal interest rate is down at that point, it's actually going to adjust down. So like it's not just, we're going to get you at 7 years and just skyrocket the rate. It is whatever the base is at that point. It'll go up or down accordingly, and it can adjust periodically after that. So for instance, I bought an investment property last year on a 7-1 arm. My thought process behind it is, I think I locked in at 6.875 on an investment property. So investment properties, for those that don't know, you have to put 20% down. The rates are usually higher, almost always higher than they are on a primary residence. So I paid kind of and I think I bought some discount points on that too. So I bought down to 6.875 for on a 7-1 arm. My reasoning behind that is I am fully confident that at some point within the next 7 years, that interest rate is going to drop below 6.875. And at that point, typically the rule of thumb is if it drops 1 point, so 6.875, if I get down to 5.875, I'm going to go ahead and refinance that on a 30-year conventional fixed rate mortgage, pull some money out and buy another investment property. That's the reasoning. If I'm wrong, we'll see what happens in 7 years. And I'm fine with that. So it's really about weighing the risk and your risk tolerance. And that risk was better for me than locking in at 6.875 for 30 years because I think I'm going to be able to refinance in 7 years. And again, I should back up. The 6.875 was lower than at the time the
Right.
7.5% rate that the 30-year conventional called for. So I locked in a lower rate for 7 years guaranteed, and then within that 7 years, I'm betting, I'm rolling the dice that the interest rate is going to drop lower than that, and I can refinance and pull out some money. So these are things that our clients can come to us and talk about and kind of think through the numbers. And listen, I can't pay 7%, but I can maybe pay 6.25 on a 7-1 arm or a 10-1 arm. Obviously, 10-1 arm being 10 years, it can change the rate. Anything shorter than 7, I'm personally not comfortable with. I don't think that's a long enough runway. There are 5-1 products out there, things of that nature, 3-1 if you want to get really crazy. But to me, that's more like hard money. And I think, the 7-year run is the shortest I'm personally comfortable with. 10's even better. So it just gives you longer to see how this whole inflationary period is going to shake out. And at that point, you can refinance, hopefully at a lower rate than you locked in at. So, and it's not going to be like, I'm paying 7.5 on a 30-year conventional and 4 on a 7-1 arm. Like it's not that the spread is
Right.
not that much bigger. But if you're talking 1%, that's 10% more house you can afford. So it's significant. So just some things to explore. And these are, we work with lenders. One in particular is a former EFM, and she's phenomenal and has all these different products that she can offer our clients to just explore their options. So it's not just like, all right, Rocket Mortgage says this, and my lender says this, and it's this rate. There's different things you can do based on your strategy and your risk tolerance. That was too much. I talked too much, Bryant. I want to hear more about 2-1 buy downs and some of the things
Well,
you're
first,
thinking.
I
Get off my
do.
soapbox.
Right. I do remember that last week I did say something about when I had a lunch with one of my loan officers and what he had said to me about what loan officers like to use for when they mortgage their properties, their personal ones.
Yeah.
They're most of them, I was told, use arms. I was really surprised by that. And the reason he said that is because, well, the reason why he said, that most people do that in the lending industry is because they already know that the average person doesn't stay in a house for 30 years. They stay in a house at an average of like 5 to 7 years and then they leave. So why would you lock in a higher rate for 30 years when you know you're most likely going to move or you're just going to refinance after
Refinance.
5 to 7 years anyway? So lock in a lower rate, save all that money on the monthly, get into a little bit nicer house. And, they know that interest rates aren't going to shift dramatically. Right. And if, they have 7 years worth of equity in their house, at the when they have to refinance, they can always buy down the rate even
Yep.
further than, like, let's say, you get 6.5 on an arm, whatever, and then when it comes to refinance, it's at whatever reason, it's at 7.5. They can buy down, get back to the lower than they had with their arm if they really
Yeah.
want to, or they can just do another 7-year arm, right, and
Yeah.
roll the dice again. But that I was really surprised by that when he told me, and this guy's been in the lending industry for over a decade, right? He knows what he's talking about.
They know better than us. Yeah, and
They know
and
better
that's
than
why
us, right?
I mean that's why we lean on professionals. Like we know our space in terms of being real estate agents and in the investor space, but like we lean on lenders heavily. Like when people
Hmm.
ask me questions, very specific questions about, what should I do here? I say I don't know. This is what I would do. But,
Yeah.
talk to Liz, talk to Phil, talk to the folks that we work with, and they'll walk you through all the scenarios with very specific details about how that fits your situation.
Yeah.
So I'm a huge fan of just talking to people that are way smarter than me, and we advise our clients to do the same. Like I can give you general principles, and that's what we're doing here.
Mhm.
But when we want to get real specific, talk to the pros and see what they do. I mean, it's the same thing as like when people come to me and ask me in other markets, how can I find a good investor friendly real estate agent? I'm like, ask them how many properties they own.
Yeah,
I don't
exactly.
work with investor agents that don't invest. Like you
Mhm.
can spit numbers all day long and run calculations for me, but like if you
You
don't
don't
invest,
know.
if you don't believe in the asset class enough to put your money behind it, that's not someone I want my clients working with. So, talk to people that have loans and also write them. Like that's the best way to get educated.
Yeah, and actually,
Yeah,
caveat that arms don't always have better rates, right? It's
right.
not always, it's based on all those multiple factors. But when I talked to that same lender yesterday, he said that arms just aren't appealing right now.
Yep.
So
A
30
great
30
point.
year loans, 15 years, or the 2-1 buy down, which some I want to talk about here in a minute, are what he's driving people towards those right now, because arms just don't make sense at the
Yep.
moment, which I don't know why. And that's when
They
you
do.
got to start talking to a
They do.
professional, right? Like I just
Right.
know that arms aren't appealing at this moment, or whatever his calculus is on the interest rates where they're going. So
Yeah. No,
with
that's a great
that,
point. This is not
yeah,
the arm is not the magic bullet. It just happened to be like as rates were going up, 75 basis points per month there for a while. And like it was getting up over 7. I was like, whoa, and I talked to my lender. I'm like, what can I do here? What other options are there? And at that point, the 7-1 arm made more sense because it was a better rate. But like you said, right now, and who knows what goes on behind the scenes, right now, it doesn't make more sense. It might in 3 days, but right
right.
now, it's not the best move. So I
Yeah,
appreciate the
in our
reminder.
plan, no, and our goal is really just to say, hey, these are other options. Other options you
Exactly.
need to be asking a lending professional. Hey, what about an arm? I don't want to, is that an option for me? Let's talk about that. So, anyways, let's go into the 2-1 buy down,
Let's do
which
it.
is another thing, another thing that I just talked to the same lender about yesterday when he told me the arms weren't a great product right now. So, a 2-1 buy down, in the very basic term, is you lock in an interest rate, let's say 6.5 for the first year, you get a 2% lower rate. So 6.5, 5.5, 4.5. You be a 4.5 rate for the first year. Second year, you go to a 5.5. And then in the third year, you go up to that 6.5 where you originally locked into. So this is for a 30 year, 15 year, 30 year term. Well, I don't even know if it's 15. I know, 30 for sure. I don't know if it's 15 or not. I shouldn't say that. Um,
Yeah, I'm not sure
but
either.
the benefit of a 2-1 buy down over an arm is that in, after that third year, or after that second year, when you go back to a 6.5, it does not go any higher than that. Like you don't have to refinance out of it like you would in an arm potentially if things are going bad. You don't have to accept whatever the market rate is at the time. You can get into a house in year one with a heck of a lot lower monthly payment. As you move into the next year, when you make a little bit more money, and you can have a little bit higher interest rate, and then in your third year, when everybody kind of over time makes a little bit more money every year, you're still going to be, you're still, at least you're in a house, right?
Mhm.
Because 2 years prior, you might not have been able to afford a 6.5% interest rate,
Right.
and you'd be renting and not continuing to build your wealth. So just like the arm, the point of a 2-1 buy down at this point in time is you want to try to get refinanced out before you go back up to that top rate that you locked in at
6.5.
6.5.
Yeah.
So within the first few years, you want to try getting into some other product, most like, preferably a 30-year loan with point buy downs into the lowest rate you can possibly lock in at that time. So I'm a fan of 2-1 buy downs. Like I said, I have a client looking at it right now. She wants to get into a row house in DC, and interest rates they kind of took a dive the last few days, and they're expected to come back down a little bit, but at the
Yeah.
moment they're a little inflated. So I was like, hey, listen, you need to look at one of these 2-1 buy downs, because you can get into a house and then hopefully get refinanced out after the first couple of years, because everybody in the industry really has a good feeling that interest rates are going to come back down. Not to 3, 2, 3 or 4s, but into the fives or so and hover around there, which is going to be a really good interest rate to lock in over a 30-year period. So
Yeah. No, it's a really interesting product, and it costs a little bit more upfront. I mean, you have to pay what a certain amount of
true.
discount points. So you pay a little bit of it forward,
The
but
seller
obviously
has to cover some of those costs too.
so yeah. So
So
it's this is some of those things that we negotiate with our deals is having sellers buy down points in this environment if they want to sell and things like that. So this is all kind of behind the scenes type stuff that we help our clients do. But the financing piece is really it's a team effort. It's
it
very
is.
much like talk to Brian and I about kind of the front end piece and how it works generally speaking, and then we're going to put you in touch with people way smarter than us and people
Mm,
that watch these rates every single day and just know what
so much
products are
smarter.
available.
So much smarter.
Dear God, so much smarter. But they, I think, yeah. Again, the point is to not. It's not 30 years set it and forget it all the time. I mean that's it. That is the go-to. That is when people think mortgage. It's 30-year. It's fixed rate.
You're
It
stuck
never moves.
30 years and that's it,
And it,
right?
it that's great. When you can get that at the right rate that works for you and you can buy the house you want, that's fantastic. It's one of the best financial instruments in the world, in my opinion. But in places where it's a little bit, you can't quite get the house you can afford that you want, you can't quite afford based on the 30-year fixed rate, there are some things to explore. It's not just like, I can't look now. Let's look at some different options and work with lenders that know the game better than we do. Yeah, so think about that. 7-1 arms, 2-1 buydowns, all kinds of weird little names. We can put you in touch with folks that can talk you through the details. But I think, again, the point behind this is as interest rates continue to go up, don't just stop looking for houses. Like there are deals to be had, there are things to negotiate. And that's what we find fun. Like anyone can just go find a house and say 30-year, here you go, blah blah blah. But no, let's see how we can make this work for you.
Right.
It's fun for nerds like us. So
Yeah, and there's so much strategy within those strategies. Right? Like a 2-1 buy down. Some of the costs have to be paid by the seller, but hey, let's just buy the house for $5,000 more on the books, and they'll give that $5,000 back in seller credit, so we can buy
right,
down our rate. It might cost us an extra $5,000 over a 30-year term, which is like a couple bucks a month,
right,
but or it's going to save you so much money,
tens of thousands
tens of thousands.
in
Yeah,
interest.
again,
Yeah,
in right now the market is allowing for that. Still in a couple months, like it was in 2022, you were giving up everything just to get a house. You
yeah,
couldn't ask the buyer or the seller for anything, right?
no.
So we're seeing that now, or at the moment anyways, we're seeing that sellers are willing to do some seller concessions, or allow for the contingency periods to play out and all that kind of stuff. So
Some places. We'll see how it is in a week. It is
some places, yeah.
it's getting hot. It's getting hot again. So yeah, and that's why we're doing this, Brian. We're doing this on a weekly basis to keep folks informed.
Yep.
This week we can still get some concessions. Next week, we really hope we still can, but we don't know. So we'll let you know next week. As always, we would love if you could share this with folks. We don't know how to do social media. Bryant does. Bryant's apparently just blowing up the world with his social media. I don't, and I never will. So if you could share this with some YouTube folks and some Twitter people, and have them put it on the Instagram, then we'd really appreciate it. Smash that subscribe.
Smash it.
I hate it, dude. I hate
I,
that phrase. So I had to say it. I had to smash that subscribe and tune in
yeah.
next week. We're going to talk some different strategies. We're talking very macro stuff, but how it affects you on a micro level and how you can get into the property
Yeah.
that you want here.
Yeah, and I
So,
think we just had. Sorry to cut you off, Tim, but
no, please.
Keller Williams just had their big event out in California, and we got a bunch of slides from what they talked about, and
Yeah,
there's a lot of really interesting stuff in there, and I think that a lot of that stuff really tells a story about where this market is right now, and takes care of some of the misconceptions. And I think that'll provide some good data and some good talking points for later episodes,
for
breaking some
sure.
of that stuff down, right? Like, I don't know, there's some really good data in there, like, that people have misconceptions about, like where the market's at today compared to where it was 5 years ago. Like, they this data just debunks a lot of that stuff. So
It
I'm
is.
excited.
Yeah, no, me too. And we're all about education. That's the whole reason we're doing this. It's just share knowledge and help people get the right information. And I think the headlines right now are very clickbaity. Like there's a bubble coming, there's a crash coming, interest rates are never getting lower, you can't afford a house anywhere in America. Like there are certain elements of truth to all this, but it's not backed up by data. and
Right.
like these slides were really, informative and just saying, listen, yeah, things are a little bit different now than they were, but like let's look on a trend, like everything's kind of normal. So it really just helps pull back, rein back in that panic button and just say let's go forward with knowledge and education, know what to expect. Again, that's why we're doing this. Know what to expect in the market and go forth with confidence. Yeah, so I'm excited to talk about all that stuff and just we can even if you can figure out how to put up slides on this thing, I think I can even do that. We can share the screen and do some slides and show some graphs and make it pretty.
That
Maybe next week.
sounds
Maybe next week we're gonna
We're gonna have
experiment.
to practice
We
before we
might
do
break
that
the internet.
live. Yeah.
You can
I won't
we're
embarrass
very well
myself just
rehearsed.
yet.
We always practice. We always practice
Yeah,
this.
right. Oh boy.
Anyways, we hope you
Um,
enjoyed this episode. We're excited to be here. And hopefully you find some value in it. Share with friends. If you have questions for us, please reach out directly. You can, email us, call us, reach out on the Stateside website, Facebook. We will respond and answer any questions you have. Happy to talk about this stuff all day. So until next
Absolutely.
week, happy market updates and keep it simple. Don't freak out. Everything's cool.
Everything's good.
Still got to get the sign off, man. I'm
I know. I was
all right.
supposed to come up with one, but I did not do that.
You're not doing any of your homework. Next week,
I'm
Brian's gonna
not.
have a great send off. That's gonna
Probably won't.
re-
Maybe. We'll see.
we'll see.
No
To be
promises.
determined. Until next week, we'll see you. Stateside market update. Bryant and Tim. Thanks for tuning in.
Thanks, guys.